Hey, everyone. Thanks for joining the Liquid Token Fund LP call. First, I just want to wish you all a happy new year. 2022 was pretty savage year in the financial markets. So hopefully 2023 will be better for the markets and for all of us. We have my partners, Joey and Paul, on for this call, and some of our other staff. So if you have questions, feel free to use the Q&A box. We're certainly here to answer every question you have. So we'll try and answer questions real time as we go. But if there are some that are of general interest, we'll hold them for the end to do together. So first, I just want to give a couple of quick macro thoughts. You might have seen it, but we shared our investor letter yesterday. And although the blockchain asset class had, what historically would be a very large downdraft, if you look at it in perspective, it actually is kind of, it is pretty amazing how resilient blockchain has been. Tech-oriented equities, like Tesla and Meta, are down quite a bit from the beginning of 2022. And then, obviously we've had some, super crazy and potentially even criminal acts in our industry that are, really, really extreme. So for the blockchain asset class to be down kind of in line with that actually is somewhat resilient. Paul and I and others have been managing blockchain assets for 10 years here. We've gone through 4 crypto winners. This one is very similar in depth to the previous 3. But I would say that in the previous ones, I was really actually sweating it, whether, blockchain was going to work or whether Bitcoin would fail or whatever. And in this case, unfortunately, it's just a bunch of extraneous actors like Sam Bankman-Fried and all the highly levered centralized lending entities that ultimately blew up. And on the next slide, we have just kind of a synopsis of our views that, blockchain is very resilient. In 2015, 85% of the market was going through Mt. Gox, and Mt. Gox went down, and the market, bounced back through that. And so we've seen this, a bunch of different cycles. And, it's really unfortunate that, some very bad actors put our industry on the front page of the newspaper. And it probably will be like that for, the next 6 or 9 months. But it doesn't have, really anything to do with blockchain itself. And we're extremely bullish on the industry itself. So the agenda for today is we'll have Joey go through the performance of the fund itself, what we're invested in, what we're looking forward to in the new year, and then I'll come back with some updates on the firm and some kind of bigger picture thoughts on the markets itself. With that, I'll hand it to Joey.
Thanks, Dan. So kind of looking back on 2022, this is kind of just a very high level summary of the thoughts that I wrote in our letter this week. But, if you look at 2022 in crypto in general, it was sort of the year that the crypto credit market, effectively blew up. And, almost all these entities that failed kind of had the same underlying story, which is they're lending large amounts of capital to relatively risky counterparties, either without sufficient collateral posted or without sufficient risk limits on that collateral. If any collateral was posted at all, often a lot of these businesses, lent to counterparties solely based on, trust and blind faith, and didn't require them to post any collateral. And, if we go to the next slide, one of the main theses that we've had for a very long time is that you can replace a lot of these entities with, decentralized protocols. And if you look at DeFi in 2022, for the most part, there are some exceptions, but for the most part, DeFi actually worked quite well for 2 reasons. One is that DeFi protocols usually force people to post collateral, and they have pretty aggressive risk controls. And so, it doesn't matter who you are or how kind of rich or famous you are in the regular world. The DeFi protocols don't care. They're going to liquidate you just the same as, some random anonymous person. And I think that's actually a really important thing. In software, there's kind of this notion of like worse is better, meaning like a simpler solution that's not as elegant is often better than a really convoluted, complex, supposedly elegant solution. And I think that's true here. A lot of these centralized businesses that failed supposedly had these very beautiful, elegant risk models. We've now found out that either A, those models weren't as elegant as they thought, or B, in many cases, they didn't really have the model at all. They were kind of just YOLOing it. And in DeFi, since you don't know who your counterparty is, you can't like do those sorts of things. You have to operate in an environment where you can't trust your counterparty. And so that's basically the second point. It's like with a DeFi protocol, if it's designed correctly, you don't have to trust it. Whereas in centralized finance, trust is pretty inherent to it. As kind of Nick Szabo put it, trusted third parties are security holes. And they're also risk holes, right? Like they're problems where you have too much risk, and having trusted third parties basically allow that to happen. Versus in DeFi, assuming that you're creating the protocol properly, like that shouldn't happen. And so, if you look at kind of 2022 as a whole, it basically highlights the need for, trustless or trust minimized systems. In the past, people kind of did things in a peer-to-peer way with other humans. Then kind of this notion of institutions became a thing. The corporate form, you engage with an institution. The institution has some guardrails around it. It's probably regulated in some fashion. There's some laws that apply to it. But institutions can they're just people at the end of the day that make up an institution. And so they can do bad things. They can steal things. They can kind of do anything that could happen in the peer-to-peer system. It's just harder for that to happen because of the fact that there's a lot of these guardrails around it. But you still have things like Enron or FTX, even when, even if you have everything within the corporate form. And so, I think the future of how financial transactions work will be programmatic, where you're engaging with the computer. And the computer basically has, some sort of software that's running on it that, can't be modified willy-nilly. And, the honesty is basically incentivized by economics and profit. Like it's in MakerDAO's incentive, as an example, to liquidate people whose collateral ratios are below a certain percent. It's not in their incentive to kind of let the risk bubble up and, hope that the person on the other side is on it. That's just not the design structure. And I think that's a much healthier financial system, even if it is, less efficient. I think it kind of fits the criteria of worse is better. If you're lending to people on DeFi protocols, last year you're using, Maker, Compound, Aave, you didn't lose your money. If you lent your money to, Genesis or Three Arrows Capital or whatever, you lost anywhere from 100% to, some meaningful percentage of your funds. And so now kind of turning it back to the sort of regular kind of performance call structure. So from a performance standpoint, kind of at a very high level, life to date, the fund is up about 72.6%. There's currently about 13 positions in the portfolio. If we go to the next slide, we can look at kind of the breakdown of 2022. As Dan mentioned, this is a very brutal year for risk assets in general. Brutal year for kind of liquid tokens. And so if you look at 2022, the fund was down 80% relative to Bloomberg. Bloomberg was down about 71.6%. And then if you look at January this year, the fund's up about 47.3%, and Bloomberg's up just under 40%. And I'd say when you think about kind of positioning the fund at a very high level, we're very long bias fund. And in 2022, the main thing we try to do is navigate a lot of the portfolio, a lot of the alts that we held into ETH, kind of late spring, basically, to try to avoid, further drawdowns versus ETH. And, I think we're just starting kind of now recently to start to rotate back into some alts that we think are going to outperform ETH over the coming cycle. And, we'll kind of talk about that in a moment. We can go to the next slide here. And so if you look at kind of over the last quarter, October, November, December. These are kind of the largest contributors to performance, both in the upside and on the downside. Looking at the names, November is an interesting month because of what happened with Solana and FTX. We did hold a Solana position. We sold a lot of it kind of early after the FTX news broke, when I think Solana was roughly in like the low 20s, high teens, low 20s, and so kind of avoided the subsequent further drawdown later in the month where Solana got into like the $10 range. And then if you look at kind of stuff that's been performing well from a performance standpoint, one of the strongest performers recently is Optimism, which is one of our larger kind of non-ETH positions. In November, it didn't really draw down very much. It was down, a few percent. And in January, it's up a lot. It's up about 138%. And so if we go to the next slide, we can kind of look at what's contributing to performance currently. Obviously, ETH, we have a meaningful position in Uniswap as well. The thinking there is it's one of the first assets that I think is truly a sort of like pseudo monopoly player, meaning it has a huge amount of market share among DEXs. Continues to have pretty cutting edge tech relative to the market, and I think it's going to be one of those things that captures a lot of value long term. It's sort of the first kind of really breakout DeFi app, I think. So you have a meaningful position in Uniswap. Optimism is another thing we have position in. In general, the thinking there is that in this next cycle, one of the big narratives is going to be kind of the adoption of layer twos. These are scaling protocols that enable Ethereum to scale, have more transactions per second, lower transaction fees. And there's two leading ones. There's Optimism and there's Arbitrum. We're actually bigger fans of Arbitrum because we invested in that in the seed stage, but it doesn't have a publicly traded token currently. Optimism does, and so in the liquid fund, we own an Optimism position, and that's up quite a bit this year. And they have currently roughly 30% of the kind of total value locked in layer twos at the moment. We also own a position in Matic/Polygon, which is kind of another player that's in a similar space there that I think we'll see a lot of upside in the next cycle. And so the way we're kind of thinking about things at a high level from a portfolio standpoint is, through most of last year, we effectively rotated into very high percentage ETH. If you look at kind of the market cap weightings, a lot of the mega cap position is ETH. And then recently we started to rotate out of that, where ETH is becoming a smaller portion of the portfolio than it was, a couple of weeks ago. And I think, once we sort of have confirmation from like a technical analysis standpoint that DeFi is bottom versus ETH, I think we'll probably rotate again back into DeFi. There's really interesting stats on like the total size of the crypto market and what percentage is DeFi of that. And it depends on how you count, but it's usually about a single digit percentage of the market cap, which I think is really undervalued given how much of like actual adoption in crypto is going to come from DeFi. And over the last 2 years, DeFi has drawn down, depends how you count and what time you start, but roughly it's drawn down roughly 80% or so versus ETH. And that's a position that we've largely been out of. So we didn't hold that all the way down versus ETH. We mostly didn't hold too much DeFi stuff for quite a while now. And so we're sort of excited to be able to finally rotate back that back on close to the lows, because I think that's going to provide a huge kind of relative outperformance as we enter the next cycle over the next 2 or 3 years. And so if you look at kind of different use cases, this is basically very heavy layer ones right now, have some layer two positions, have some DEX positions, have a handful of miscellaneous DeFi things, but again, you're not too heavily invested in DeFi right now. I think if you look at kind of the layer one blockchain position, we're still underweight that versus the market. But I would say in a bear market, we try to kind of get our layer one position closer to the market. And then in a bull market, we try to get our token position way higher and our layer one position way lower than the market. So I think in bull markets, other tokens tend to outperform layer ones and kind of vice versa in bear markets. And so as I mentioned, we're just kind of starting that rotation now. And so if you look at it kind of broken down by category. I'm trying to see if there's anything. One thing we haven't covered, we do actually have a position in Chainlink, a relatively small position. I think it's probably fairly close to bottoming out versus ETH. It's an asset that had a huge amount of hype in the last cycle. We kind of mostly avoided it through the hype cycle, but I think it's probably fairly close to its sort of trough of disillusionment. Outside of that, the only other thing that's worth noting here on the slide, I think, is our position in Arweave. That's something that is very different from the rest of the portfolio. Arweave is doing decentralized file storage, kind of similar to Filecoin. It has a good amount of actual traction and usage surrounding kind of the NFT space, where people are using Arweave to basically store those permanently. And I think it's, from a diversification standpoint, it's not quite like anything else that exists in the market. And so I think if you look at kind of what are we looking, towards next, what's kind of coming up next, I think there's a few things. One is that I think we have pretty high conviction in the idea that the world's financial rails will eventually end up using, blockchain-based systems using smart contracts. The kind of main questions are like, how do we get there? How long does it take to get there? What needs to happen first? And if you look at kind of the main differences from the bear market in 2018 to 2019, there were kind of really, I'd say, three big problems that weren't solved back then. One was kind of the problem of how do you on-ramp from dollars into crypto. Two was, how do you actually do transactions in a way that's cheap? If you're paying $50 to do a transaction on Ethereum, that's not very sustainable. Like, it's not going to take off. And then the third was developer infrastructure. It's really hard to build new applications in the space. And so I think if you look today, the scalability problem is largely solved. You have solutions like Arbitrum, Optimism, Starkware that enable you to do pretty high throughput numbers. The developer infrastructure problem is well on its way towards being solved. That's kind of a continuous thing, but back in 2018, stuff like Alchemy barely existed. You have them now. You have a lot of other developer tools that make it easier to write smart contracts. Testing frameworks for how do you test smart contracts barely existed in 2018. The space has really advanced a huge amount since then. The one thing that kind of still has a good amount of room to go, I think, is kind of the fiat on-ramp problem. It's just a hard problem of how do you get people, all across the globe from a ton of different currencies into crypto. There's certainly a lot more businesses working on that problem today than there were, 3 or 4 years ago. And so I think, like, when we think about it, kind of looking forward, there's really sort of two questions. One is like, what does the end state look like? And then two is, what kind of enabling innovations and protocols need to be built to let that happen? And then those kind of provide interesting investment opportunities. And so from an end state standpoint, the way I kind of envision it very long term is the average person will have, apps on their phone or on their laptop that give them access to DeFi, probably without them even knowing that it's actually DeFi under the hood. Where you can sort of engage in financial transactions that are 24/7 global with very low fees. If you've ever sent someone, USDC and then, they get it 20, 30 seconds later, that's a very powerful thing. And I think that's something that, over a number of years will be available to like the average consumer as well. Like the interface of bank wires just doesn't make any sense. And probably isn't going to be the main UX people use for sending money a number of years from now. And so if you put it in kind of one sentence, basically think about kind of the internet, but for finance. And if you look at the path to actually get there, there's kind of two things that need to happen. One is that you need more liquidity. You need more, custodians to support crypto. You need more kind of institutional capital able to use DeFi. Because you look at traditional financial markets, one reason they're very liquid is you have kind of a lot of the largest institutional players providing liquidity. That needs to be easier in DeFi. It's still fairly difficult today. There's also all these different blockchains that have different DeFi protocols on them. There needs to be some way to aggregate liquidity across them. There's a lot of people working on this, but it's not a solved problem. And then the second piece is, and probably a bigger piece, is the usability problem. So using crypto is still very difficult. It's kind of like getting on the internet in the early days was quite difficult. And there's a few different problems within crypto UX. One is like the user experience starting wallets is pretty unideal. They're pretty difficult to use. Two is just like the idea that you need to acquire ETH to do transactions is kind of a very annoying and cumbersome thing for the user. And then three is it's very hard to go from like 0, to like 100 in terms of using an app, because you have to first get crypto to do anything within crypto. And there's still not that many dApps that actually have a fiat on-ramp where you just input your debit card and you get crypto kind of right within the app. And the reason that they don't have that is it's a hard problem to solve. There's a lot of payment fraud problems that you have to solve in order to be able to do that well. And I think that problem will be kind of solved over time, but it's quite difficult. And so, today, if you want to use crypto, unless you're buying like an NFT with MoonPay or something, generally you have to go to Coinbase, sign up for an account there, buy whatever you want to buy in size there, and then send it to like MetaMask or a hardware wallet. And, if you want to do it securely, if you're doing a large quantity of money, you probably need a hardware wallet. And then like the UX around that's pretty cumbersome. You have to buy something. It takes a few days to arrive. You have to fill out like 24, words on a piece of paper and enter them manually. It's sort of a laughable user experience. And it's sort of how like if someone answered the phone in the early days of the internet, you would get kicked off the internet because of the way dial-up worked. It's like that, or maybe even worse, of the UX. And so those are problems that like they're solvable. They're much easier to solve, I think, than the scalability problems. But it's just like a problem set that, historically to date in crypto, not enough energy has been spent on solving it. And that's kind of the next phase of innovation that I think needs to happen, is mostly around the UI UX side, to make this stuff actually usable by, more consumers. And also institutions, right? Like it's still pretty difficult to use, even if you're an institutional investor. And so I think one kind of last thing that's interesting is, just despite kind of prices being down quite a lot, there's still a huge amount of kind of active developer activity within crypto. So people are still building things, which I think is very important. If you kind of saw a lot of the smartest engineers stop building stuff and kind of migrate away from the space and that sort of thing, that would be, I think, a problematic sign. But since you don't see that, it's more kind of like a leveling out, similar to what we saw in 2019 and 2020. I think that's a very, positive sign for the space. And is a good sign that, a lot of these problems, I think, will actually get solved. People are working on solving them. And with that, I'll hand it back to Dan to kind of talk about what's going to happen next.
Great. Hey, thanks, Joey. There are a bunch of great questions in the Q&A box. Some are kind of general interest, so we're going to save them to go over after the end of the presentation, which is only a few slides away. But if you do have questions, feel free to pump them there. So a perspective our capital formation colleague Jeff Lewis came up with is the 2003 analog to the internet. For those of you who were old enough to be around when the first part of the internet was built, it's very similar to the blockchain part of the internet, and same deal. It's going to change the world like blockchain is, but a lot of hype and a lot of kind of crazy price cycles, and everything kind of imploded at the end of 1999, and it took a few years to right itself and get going. But not all, but a lot of the most important companies were built in that period after the crash in the dot-com boom. And that analog, I think, is pretty good here. That there's about 200 million people using blockchain, which is about as many as were using the internet in the 90s. And there's too much hype, and now there's too much pessimism. And the analog, I think, serves us fairly well. We also, on the next slide, we have, essentially what happened in the other part of the internet, where, some of the most important companies were founded way after, everyone, kind of talked about the dot-com bust and was all retroactively congratulating themselves on what, too much hype that was. And so in our investor letter we just published yesterday, we went through a bunch of the topics we skimmed upon today. on the future state of the market, but there's some fantastic articles by the rest of our investment team in there that cover a bunch of the topics that we think are interesting. And then we wanted to make sure you knew that we were going to be hosting our next blockchain summit, again in San Francisco in person, getting back to seeing people in person, which is fantastic. We would love to see as many of you as we can. If you have interest in attending, there is a link there that will be part of the email that we'll send you after this call. The venue, we've rented out the entire Ritz-Carlton San Francisco, and it's constrained at 600 people. And so we'll make every effort we can to include as many LPs as possible. So if you're interested, please do submit your interest there so we can try and get everybody in there that's interested in coming. We will, unfortunately, probably be capacity constrained, so it will be based on size and longevity as a partner in Pantera. And so we'll certainly make those who've been here the longest a priority. With that, that concludes the kind of the big picture thing. There's a bunch of questions. The first and most popular one is regulatory questions. In talking to our existing LPs and other big institutions, everyone uses the phrase, what about the regulatory backlash? And, you know, I would actually say, I really view it the opposite, that in most countries, regulators have been neutral. There's a couple countries like Switzerland and Luxembourg where the regulators are very actively trying to promote blockchain. And then, unfortunately, the United States is an outlier. Most of the regulatory agencies in the United States have already ruled on cryptocurrencies, and they ruled 6 to 10 years ago, which is fantastic. Unfortunately, there's one very powerful agency, the SEC, that has not yet ruled. And I would say that they even, to some extent, by not ruling, by not providing clarity, both on what is a security and what is not a security, and then on whether an ETF is permissible in the United States, they have essentially kind of contributed to the scale of the problems we've had in our industry. Regulated exchanges like Coinbase are afraid of listing certain assets on their platforms because they might retroactively be deemed to have been unregistered securities. And so their kind of conservatism in the face of potential SEC enforcement action has allowed offshore unregulated exchanges like FTX to prosper. And at the extreme in November, FTX and other offshore exchanges were doing 95% of global crypto volume, which is, you know, obviously crazy because, you know, say US, and they certainly aren't trading stocks in the Bahamas or Dubai, whatever they're trading in the New York Stock Exchange. And so it really is the inverse of the way it should be. Almost all trading should be onshore and regulated, and a very little bit should be, you know, offshore. And then the same thing with the ETF. The lack of an ETF created the Grayscale Trust. And Joey went over some of the centralized failures in the system. Really, the one thing that all of those entities have in common is, well, two things actually. One is that they were mainly counterparties to each other. So, you know, many of the entities that failed were counterparties to each other. And then the majority of them had some of the Grayscale arbitrage on as a trade. And so, unfortunately, the lack of regulatory clarity, in my opinion, actually contributed to the scale of the problems that we saw. And so it's highly likely that anything that the regulators do say, specifically the Securities and Exchange Commission of the United States, has to be good for our industry. And I would think that, you know, for better or worse, regulation is coming. And I think it is on the margin highly likely to be good for our industry. It'll bring more institutions into the space, more, you know, legitimate investors. There were a bunch of questions on the markets themselves, the crypto markets, and I'd be the first to admit we didn't anticipate how much leverage there was in the system last year, and certainly, although we never invested in FTX, I would never have guessed there was a massive fraud and embezzlement going on there, as is alleged. And so those things were much bigger and worse than we anticipated. But I would imagine we're really coming to the end of that. As I said, all those were counterparties to each other. Those are being worked out, including Genesis declaring Chapter 11. There's really only two other shoes to drop, as people are saying these days. One of which is a worry. Binance, is potentially a worry because they are not transparent, they're not regulated, and they're very opaque. And the other one's Tether. And so on the Binance one, they don't have audits like Coinbase uses Deloitte, Bitstamp uses Ernst & Young, and that is the only way you can be sure that your exchange is solvent and reputable. And then the other one so I think that's at least a potential worry. But the Tether one, I don't think, although they probably did lose some money along the way with interest rates at 4 or 5%, they're making back that hole at a rate of 4 or 5% a year. So I actually don't think that's a big one. And I would say that I think it's all priced in now. Bitcoin as a proxy for industry went down 77%. It's been down for over a year, as you all know too well. And that's really unusual. The longest bear market in the 11 years Pantera's been doing this is 400 days. So, it's been a very long bear market, and it's my intuition that we've already seen the lows for the cycle, and then we'll grind up at kind of potentially a historical pace. And there was a question about how has that changed our valuation frameworks. I think the kind of the one thing that is different is we have to try to anticipate excessive leverage positions, and hopefully we've worked that out in our industry, and it's not likely to be repeated. And then there was a question about the macro type stuff, about whether one should believe the Fed or whether one should believe the futures market. And there's an old saying, don't fight the Fed on Wall Street. And I really believe it's the right way to go. The Fed knows way more about where rates are going than the futures market does. And if anything, I would say both of them are probably a bit too sanguine about how we can start cutting rates very quickly. I think it's difficult. And with that, I think we've answered most of the questions that I had seen. I'll give Joey and Paul a sec to answer some more live if they want to take it.
Yeah, there's only one question I see about quantum computing. Someone asked if that poses any risks to the crypto ecosystem. And I'd say for the most part, not really. There's kind of certain weaknesses within cryptography that crypto uses that could be vulnerable to quantum computers. But by the time there's sufficiently good quantum computers, I think crypto will switch to what's called quantum safe cryptography, or cryptography that doesn't have any vulnerabilities with respect to quantum computers. So it's more of a theoretical concern. It's not really a concern in practice, and it's probably at least 10 years away, sort of thing. So I would say that I'm not really worried about that.
Thanks. With that, we have answered all the questions you've all had. If you do have additional questions, please shoot them to ir@panteracapital.com or route them to the right person on the investment team. And thank you so much for participating. Happy to hopefully see you in San Francisco in a couple months.